Joining me now is Michael Kantrowitz, Chief Investment Strategist at Piper Sandler. Thank you for being here, Michael. So let's get into the terminology here, because one thing that Gates was saying to Andrew earlier today was this notion that a bubble is used to describe both the 17th century tulip mania, as well as what we saw in the 1990s and early 2000s with regard to the internet. After the internet, there were a lot of real companies that came out of it. So it wasn't just this speculative bubble with nothing to show for it. And he thinks that's more akin to what we have now. Do you think there's an appropriate description for what we're seeing in AI now and how it relates to maybe the bubbles of the past?
Yeah, there's certainly some echoes of bubble-esque behavior, but we would characterize things more as a boom today. Generally, the characteristics of a bubble are a good economy, and overall, I'd say we have a good economy. Easy money, which is something we're moving back towards with the Fed raising rates. So I think if we want to characterize this as a bubble today, it's unlikely to pop in an easy money environment. I think it ultimately could end from a macro perspective, partially why 99-2000 ended, if we get another tightening cycle.
But we did see, I mean, a lot of the surge in spending took place when rates were historically, relatively high, at least relative to the past decade or so.
Yeah, in the late 90s?
No, the 2022, 2023, and
yeah. A lot of those companies, though, that are so fully matured also, and that's a big difference between today and the late 90s, were that a lot of these companies, again, have really good fundamentals, so they were almost able to self-finance through free cash flow, so they're not as rates dependent as some other speculative parts of the market that have also gone up as well. Yeah,
and to your point, earnings will be a key factor here. Tomorrow and Thursday, we get earnings from the 5 companies that account for a quarter of the S&P 500. Do you think we'll hear from them that the AI theme is all systems go, and how much margin of error do you think the market will give them for the results that come out?
Well, I think unless there's a real bomb being dropped, proverbially, that what we've seen in the last couple of years is markets have moved from a couple of the Mag 7 stocks or AI stocks, and then will rotate over a period of time to other ones. So between Microsoft, Meta, Google, Amazon, Apple, there's always a few of those names that are shining. So what comes out of this earnings season could perhaps propel the best 2 or 3 going forward. We're viewing this from a macro perspective, and we don't really see any macro headwinds to stopping this story. And ultimately, listening to our technology strategists, we hear that things are still have momentum to carry on.
Yeah, I saw in the notes that you believe that earnings will be the key factor in 2026 too, as markets have priced out nearly all macro risks. And I just wanted to kind of push you on that a little bit, because the last few weeks were pretty volatile as it pertained to trade tensions back in the forefront. Of course, now they've abated somewhat. There were the credit risks at the regional banks. That also has abated somewhat. So it seems like investors are still attuned to the macro risks.
Absolutely.
But maybe you believe that they're kind of self-correcting in a way that tunes them out pretty quickly?
Yeah. If you think about the last 3 years, markets drifted up pretty broadly. I mean, the index has been led by AI stocks because of stronger earnings, but you've seen a broad improvement because inflation risks have come down. Rates moving higher, risks have come down. Recession risks, I would say, have come down. And to the extent people are still worried about softening labor markets, it's being somewhat offset by falling interest rates. And in a backdrop where people are still so focused on inflation, I think that can persist for quite a while longer. Markets are going to continue to absolutely be very attuned to macro, but we got here today because the market's current view of the macro outlook is that risks are very low. Of course, if something pops up, markets will react, as we saw last week and the week before and the week before. But ultimately, whether these things go from being idiosyncratic sector issues to being systemic is really the key question. We don't think unemployment's going to be rising sharp enough to see that. And we would actually see that in 2026, we think the data actually gets better, and the biggest risk to the market, or perhaps the next correction, could be because things are overheating and the market has to price out some of those rate cuts.